Welcome to the latest edition of the Brooks Macdonald podcast. My name is William Hobbs, the Chief Investment Officer here. This week, it's another in a series of superstar fund managers. So Sid Chand Lall is the manager of the Marlborough Multi-Cap Income Fund, has been doing it for some time, I have to say. And before I've got to do a small disclaimer. So the conversation we have right now with Sid, between Sid and I, there's no recommendations in any stocks that Sid mentions, I should say. They are illustrative. So the conversation we're trying to have here is about really some of the sort of difficulties, challenges, and skill sets you need to be, a top class fund manager like Sid.
Thank you. That's a wonderful introduction, Will. I'm glad you corrected yourself and recommend.
Yeah,
we are only here to discuss ideas. It's very much the illustration, as you say, and the thematics of it. So I shall answer accordingly. But you're right. A number of them will be held in the fund, and we may be trading it at any time. So definitely not advice.
Yes, good. So I think the first point to make in amongst that is that the global economy remains in pretty good shape. It's a pretty benign overall macroeconomic backdrop. To that extent, actually, we've just had the major banks in the US report their latest earnings. And the message that we are getting on the US economy remains incredibly constructive, both on US consumer and the wider US economy. For a start, there's no obvious deterioration so far evident in credit quality. You're seeing a broadening in sort of credit demand beyond just sort of credit cards. On the corporate side, you've really had a standout quarter, and it's not just loan growth for AI financing, but also your sort of middle market borrowing for wider capex, capital expenditure. And on top of that, the banks are obviously enjoying a sort of capital market super cycle. So you've had across the major banks a 19% return on capital employed. Now, that doesn't mean anything to normal, healthy human beings, I'm sure, but that is a massive improvement, not just on last year, but it's the best we've seen since the great financial crisis. So that is a sense that the US economy and indeed the wider global economy, the macroeconomic backdrop is pretty healthy. The second point, however, is that if we look at how markets are reflecting that present health, you can certainly say now that since over the last 3 years, you've seen an incredibly intense bull run in stock markets in particular, US stock markets in particular, parts of the US stock market in particular. And actually, more recently, you've seen incredible violence underneath the surface of some of those leading stock markets. So particularly in areas we've been discussing on this podcast the last few editions, the memory stocks, so bits of the semiconductor supply chain. You've now seen huge sell-offs in parts of that area, but overall, sort of at the index level, it seems quite calm. But obviously underneath, there's an awful lot going on. Now, that leads us really onto the third pit and really into the conversation with Sid, is that we are, as investors, this is a difficult part to investing in many ways, because what you've got is this industrial revolution we've been talking about a lot. In part, this is part of a wider information revolution, incredibly attractive times to be investing and letting your sort of, your savings work as hard as they possibly can, but also quite an unnerving period because you are obviously lots of things are going on underneath the surface. So it's about trying to keep skin in the game, but also maybe pull your portfolio's horns in just a little bit to keep yourself feeling not too in danger as markets go wild. So, and before we get into it, do you know what? Do you know the origin of pulling the horns in? The idiom "pulling one's horns in."
No, please do enlighten me.
I looked it up before I came in here, and it's not what you'd think. It's actually, I hope this is true because I really want it to be, but it's the tentacles on a snail. So the tentacles, the eyes are on the end of the tentacles, and apparently whenever a mollusk senses threat, it pulls its horns in. So therefore, we are snails trying to get through the paddock, I guess. But yes, give me a little bit more. Let's start off on the proper conversation. How did you get into this game? I guess let's start there. What was the sort of path into managing? Being
that's a big question. Okay. I suppose I did what everyone does, which is look around for a bit of work experience, try and do an internship. I read economics at Edinburgh, started off with a role which was meant to be very temporary, there was no job at the end of it, and 2 weeks became 6 months, and 6 months became a year, and then a permanent contract. And I was very fortunate to be surrounded by a number of people who were incredibly experienced and very kind to me. And so I learned everything from European small mid-cap to UK, even potentially designed a fund that I'd wanted to launch then, which was the UK Equity Income Fund. But at that point, I didn't launch it, but it was a ready-made document. And then I started to work with Giles Hargreave. I actually got a job. I was about to move to Switzerland, which I did not do, and I took the role with Giles Hargreave as his analyst at the time. Worked on the Marlborough Special Situations Fund.
Okay.
Went through the global financial crisis. We actually, in that particular period, it did relatively well, did better than the market when it fell, and did better than the market when it rose. So that was noted. And then there was a chatter about, look, you're working on the Marlborough Special Situations Fund. I don't anymore, but at that time, why not carve out some of the small mid-cap companies from within that pay a dividend? You know the teams very well. It's a relatively uncovered part of the market. It suffers from all the classic neglected firm effect that we read about in textbooks. Why not, make this a proper product? And at that point, I joined together the document I had, and I said, well, it's already there. What do you think?
Oh, interesting.
And this is where Giles gave me his blessings and said, well, look, I will lend you my name and you can go ahead and run it. And if it's successful, good luck to you. So
good luck. And there it is.
And that's kind of what happened.
And what was it about this space in particular? That, because obviously this is kind of stars aligning very early on, writing this kind of, this profile of an area that you wanted to cover and ending up covering it.
Yes.
What was it about this area out of all of the others you could have covered that really stuck out to you and gave you the opportunity?
Part of it was, but that is what I did. So in terms of chronology, that is what I knew. That is the knowledge set that I'd had and experience and extensive company management meetings and site visits and conferences, and actually probably more so than the average fund or the average analyst would have done. It was very much deeply entrenched in the process. So that was something I took with me and carried on doing, and I still do. And I still write up all my company meeting notes for what it's worth. But that aside, there was another factor to it, which was the market itself. What had happened is the market got increasingly concentrated. And if you look today in fact, it's continued to get concentrated. So if you look today, I know you mentioned America and technology, and there's the Mag 7, and I think that makes up about 34% of the S&P 500 today. In the UK, we have, if I took just the top 10 FTSE 100 companies, that's about 46% of the entire market. But then if you go into the income world, which is what I do and love, the UK equity income sector is made up of just 15 companies that pay nearly 60% of all dividends. So then you ask yourself, well, if I was an asset allocator and I was buying an income fund for my clients, I could be buying 2 or 3 different types of equity income funds. But actually underneath, there'd be quite a high degree of correlation. You'd be buying inevitably, although different styles and what have you, but inevitably you'd be overlapping with a number of those big stocks. HSBC today, great company and all the rest of it, but it's 10% of the UK market.
Yeah.
Similarly with AstraZeneca, big portion, Shell, and so on. So what we did is we said, well, actually, let's select from, widen that scope, make it 800 to 1,000 companies to choose from, include another element to it, which is essentially up to your non-qualifying 20%. Not that I use 20%, but you can then include foreign companies. You can use certain collectives where perhaps that opportunity set is not available in the market through a normal company, but use it selectively and very carefully in a measured way. So again, have a wide range of companies, typically 100 stocks in the portfolio. And now I'm slightly getting to portfolio construction, but by doing that, you essentially diversify the pool of stocks that you can choose from. So nothing against the FTSE 100 large cap companies. We have some of those, but actually hunt from a totally different opportunity set to deliver that yield. And then there was another factor as well, which was essentially the small mid-cap outperformance. So over time, whether you go back to the Deutsche Numis index or what was known as Vorgevet before that, 1955, you do the time series and you can see that smaller companies have outperformed larger companies over a long, long period of time. Now, that was also true in the UK and in other countries, and it's true essentially everywhere. The expression goes, elephants don't gallop. But this aside, we look at it and we say, okay, fine. So you've got this outperforms smaller companies in earnings. Is that true in dividends? And actually, it is true in dividends too. So when you compound the returns, and this is of course the eighth wonder of the world, when you compound interest, it's there, and dividends too. And as you reinvest, actually, the significance is stark. It's so obvious. It's almost like, why wouldn't we reinvest? But you must do that over a long period of time. And that is the data that actually then was the spark for us to say, well, okay, well, if it's correct for small mid-cap companies in earnings, and we've got that experience and we've got that record, we should really leverage that and present a product which is low risk, but relatively good risk return in terms of the reward. So over time, it's actually been very boring. You talked about wildness in the markets and pulling your horns in. It's been boring in the sense that you've had 10 fantastic years. You said a long time. Well, yeah, it's 15 years in July. 10 fantastic years, 5 not so good years, or I should say 4 not so good years. And then this year's been much better. And just coincidentally, the fund hit an all-time high in terms of unit price on Friday. So that was a nice moment to hit 15 years. And
just so you mentioned a couple of things in there with sort of regards to just thinking about income investing relative to your peers who aren't income investors.
Yes.
What would you see as different? Is there a greater degree of sort of forensic due diligence on a particular part of the company's activities, its report and accounts? What do you see as the different discipline that you bring relative to other fund managers?
So the bulk of so other than concentration, the bulk of the sector is actually large cap biased. So about 80% plus of the funds in the UK equity income sector are invest in larger companies. Within the rest of them, there are differences. So there may be certain multi-cap income funds that will invest in anything with a dividend. We won't do that. We will have typically a threshold to have at least 2%. So 1.75, 2% if it's growing double digit in terms of dividends. So the idea that we don't have a barbell approach, meaning that you don't have some companies that pay 0% yield and other companies that pay 6 or 7% yield. The whole idea is to avoid a value trap or a yield trap in the income world. So by that, I mean, just for full explanation, what you don't want to be doing is getting sucked into an idea that, oh, it's 6 or 7% yield, that's going to be great for me, but then you have a capital loss instead. And so we want to avoid that. And equally, thinking, oh, well, yes, it's a 0% yield, but I'll manage to blend it and hit a yield target. Now, that tends not to happen. The zeros tend to be 0, and the 7s will almost inevitably, not in all cases, but quite often disappoint you. Which is why what we do is we say everything must pay a dividend. Everything must actually be profitable. And because we have a large number of stocks, what we're actually doing is also managing the liquidity risk. So within the small mid-cap world, there is this huge fear that, oh, if you buy something like that, you won't go to get out. Well, that's fine, but then you must also only weight that position to reflect the risk. So if there's a 100 million market cap company, I definitely would not want to be buying 5 or 10 million pounds worth of that. It would be a much, much smaller position. And what we would do is we would grow with the business. And the first entry starting point would not be a full size relative for that market cap. I actually take it one step further. I want to look at the free float as well and say, well, yeah, the market cap's one thing, but how much of the free float, the actually freely available number of shares outstanding that are traded, can I get or get out of if I need to? And so there's that constant evaluation of risk. You mentioned company accounts and so on. Well, there are companies that we have come across where the accounts are not so good. And the correct and simple thing to do is just to avoid it. Why take any prisoners or give benefit of doubt? The shares may go up for a while, and then eventually it catches up with them. So whether it's imprudent accounting, whether it's aggressive revenue recognition, whether it's actually, there's been one case which I don't want to name, but where we've had it and they actually admitted error in what they printed. And I use my words carefully. And then we sold it, but the shares have continued to do well. Now, sometimes the market is forgiving.
Yeah.
But what I want to avoid is finding that, oh, well, you knew there was something wrong. You stuck with it.
Yeah.
And then it went horribly wrong. Now, there may come a time with a change of management, or perhaps they have learned from the errors of the past and things are much better. But generally, that door tends to be, I mean, you've got to learn from your lessons, I think, and you've got to learn to avoid mistakes. And to say, what do you do differently to other fund managers? I'm sure we all do it to a greater or lesser extent, but the one thing I really want to do is go and learn from my mistakes. So when I make errors, I go and understand, well, why was I wrong about that stock? Whether it's something I missed or whether it's something that actually I bought into, and I'm not going to blame my analysts or team for it. It's my fault. Let's go and work out why I shouldn't be doing that again. I'll give you an example. In 2022, it was a very bad year for me, probably the worst year of the entire year for the fund. And what we realized is, and what we realized is we were not enough in banks, and we were not in commodities in a big enough way. And then I looked deeper into it and I asked myself, well, why was that? And actually, a number of the reasons for that was that we were worried about interest rate risk. We weren't sure whether inflation was transient. That was the term being used at the time. But as it happens, actually, inflation was there to stay. The net interest margins of the banks were very strong. There was a huge benefit from structural hedges even going forward. So I'm using terminology perhaps that I should explain, but essentially where the risk of an interest rate decline is hedged away, but effectively you pass that on a rolling basis, and you can protect yourself from losing that spread and that profit margin. So I'm trying to make it as straightforward as I understand it as well. But so eventually, so what did I do with that? Well, I said, okay, fine. Well, I don't think we should be, in that case, compounding error. Let's go back to it and look at, on a case-by-case basis, which banks we may want to actually meet with, believe in the vision, and what's different, and are the quants. But the quants are quite important to me in terms of the balance sheet. We don't like excessive leverage, but banks do lend, so you have to look at leverage in a different way. There is something called the leverage ratio, where it's different to the balance sheet gearings. And so there it's 5%, 6% for these better known names, and that's fine. But we also have other banks, and this is what I enjoy, is couple a few of those larger well-known names like the NatWests, or we don't have HSBC at the moment, but certainly Standard Chartered, and then put in something like a Paragon or a Bank of Georgia, which is now known as Lion Finance, because that's promoted. It's actually been, we had it when it was a smaller company, and it's now become a FTSE 100 stock, and there's a great joy in being able to be part of that journey. But they're more profitable as well.
So can I just ask you, so there was a couple of things that were interesting there, because you were talking about, some of the funneling process by which you take all of your available universe and sort of whittle it down to some companies that you want to spend more time with. And you talked about management and the role that you have in assessing management. What does that look like? So you go in, you grill them, you ask them a set of questions. What are you sort of looking for from management? And do you then, is it a matter of, continually going for meetings and verifying answers? What are you looking to, is there a sort of tripping up process? Things you don't like that you see?
I'd like to think I'm not deliberately tripping up anyone, but there is something to be said for a track record. So although we have this disclosure that says the past is not a guarantee to the future, that's true. But on the other hand, a leopard doesn't change its spots. And if you've generally been a bad manager, you're not going to suddenly become a good one. So there are certain traits that I think do repeat, similarly with good managers. So a good CEO who has it in his DNA or her DNA to guide well, guide conservatively, under promise and over deliver, the expression that's so often used, but actually how many can actually do it? And so this is where I try to follow those themes. Sometimes you see a CEO go from company A to company B, and you can follow them if you believe them, and then do very well out of it. And we have one or two examples of that. So I can keep naming companies, but to answer your question, that is one aspect to it. The other is to link what we do behind the scenes. So the prep work, which is reading the analyst notes, reading the annual report, understanding from quantitative filters, is this a company with a balance sheet that can afford a dividend? I don't really want businesses, or too many of them. In the case where there is a model or a reason to have debt, fine. But if they're over leveraged and you're just getting a debt finance dividend, I'd rather avoid that. So if it's got net cash or low gearing, which we define as net debt to net assets below 50%, and then you have free cash flow as a second pillar of defense, which is the free cash, truly surplus cash that can cover the dividend. There are many different definitions of free cash, and I'm happy to go into it, but my version, it would simplistically be your operating profit, add back your depreciation, your amortization, take off any capex, your interest, your tax, your change in working capital, any other cash absorption items, and then what you've got left over is your truly available cash for dividends. But the idea is that you've invested in growth. You've paid all your liabilities away, anything for a pension. And then if you can do that every year, that's a sustainable dividend in theory. And that's what I check with the team, is I go through those lines and I try and ask them, so what are your investment plans? And, these analysts have got these notes suggesting your capex range is this, your midterm guidance is that, your operating margin goals are something else. Where is the reality and what's...
But to have a view on that, Sid, you therefore, so you've got this view of how the company is right now. You've got an idea of what the management looks like and whether they're good at guidance, good at managing, these kind of things. I guess you're augmenting that with some view of what the subsector outlook is and whether that company can win in that. Because in order to sort of guess at whether, or estimate as to whether the company can keep growing the dividend and whether those free cash flow forecasts are realistic, you've got to have a view of the subsector generally. Does that mean you have that? Where does that come in? Is that part of the sort of initial screening process, as in part of the quant screen?
As part of the question.
Yes,
the relative backdrop is important. So if you're a market leader, great. If you've got some kind of a IP or a moat where you feel secure because you're dominant in that niche, fantastic. But you can't be too rigid. You've got to have some allowance for a new management team or some allowance for a business that's going through change. So if you've made a big acquisition, and this is where I make the point that, okay, you made a big acquisition, your gearing has gone up, but it's only gone up temporarily. In which case, if you're over 2 times net debt to EBITDA, the definition I gave of operating profit with your depreciation and amortization put back in, but then you're going to rapidly deleverage because your free cash flow is so good and you bought into, let's say, a high margin business. I need that to tie in with what the management is saying now. If you go and buy into a sector that's suffering and you're doing really badly, well, it can be the case that actually you bought such a beautiful business that you can be absolutely fine for the next year or two until the market recovers. And then you get the double whammy of the volumes as well as the cost initiatives, the synergies, and therefore your profits can grow. If I was to think of an example, who would have thought something like Norcross, which supplies electric showers and tiles and bathroom furniture and so on, is going to be doing well? But it's bought a business in the Nordics called Fibo, and this is a holding. But again, it's a remarkable story because they've gotten rid of some of the South African businesses which were troubling them in the past, improved the balance sheet, and have invested in a better business. And so it's become a European business. It's no longer a UK or thought of as a UK business.
Good decisions.
And a different strategy. And it's the same with a more defensive name, perhaps, in the food sector. So you look at Premier Foods, it's totally transformed its balance sheet, continues to delever again. And the same thing is happening here. You're buying into certain trends that you and I may or may not be interested in, whether it's GLP-1 or more protein or healthier eating. And then they're unashamedly also the owner of something called Mr. Kipling, which you will have heard of, or OXO. And so, so there is the treat side to it, but the brands that they've invested into are growing double digit and the balance sheet is significantly improved. So you have to be open to change. And I think this is where sometimes as a fund manager, you can go, oh yes, I've met that company 3 times or I've met that management team 5 times. But if you miss or are not open-minded to, in fact, put it simply, you've got to go and reconfirm any prejudice, because when things change, that's the opportunity. But you've got to believe that it's possible. So I mean, there's got to be more than just, oh, we made an acquisition, because actually acquisitions carry a lot of risk. A lot of acquisitions do not integrate well and might go wrong. So there is that.
That's very useful. So we're almost out of time. So I had one final question, which is really a sort of one sentence-ish answer, which is just thinking about some of the younger listeners out there and thinking about people who wanted to get into fund management or do anything that remotely close to what you've done. What one bit of advice would you give your junior self if you could look him in the eye today, starting out in the industry? What would be the key nugget of wisdom that you would pass on? That makes it sound like you're much older than you are.
I am now off that age where perhaps I can say
could give advice. Yeah,
I think it goes back to what I was saying earlier about go and examine your errors. But on the other hand, you should also be open to rejection and try and learn from a failure. It sounds incredibly cliched, but I think that is where you grow. So if you can survive a downturn, for instance, if you can look at it and say, well, how can I come back and say I'm now a better fund manager? or a better analyst. And it's the same thing, really. It's okay to make a few mistakes within reason, but you've also got to learn from them. There's no point just comforting yourself and saying, oh, but look at the sample, 2/3 of them were right, or whatever the number. Actually, the real gold mine is sitting in those errors to try and say, okay, well, what can I avoid? And how do I avoid that in the future? So I think it's partly that, but of course, finessing and being open to always learning, to sort of saying, well, you still don't know it all. Actually, you never will. And this is why, even if there's a management or a team or a company that you think you know really well, go and meet them again. You might learn something else. So I think it's about just keeping a really open mind and always wanting to be hungry and inquiring and asking lots of questions.
No, it's interesting you say that, Sid, because it's a key part of the investment process at Brooks as well. Making sure that you have a decision-making setup, an investing setup that allows senior people to admit, like myself, to junior people that they make mistakes, and that you involve the more junior, brighter, cleverer people than me at a greater level, and allow for sort of, much more coordinated or much better decisions, allowing for diversity of opinion.
It's the one thing that I really, really loved when I joined Hargreave Hale, now part of Canaccord, was that we had I know people say this, but this was the reality of it, where Giles would turn around and say, look, if you think I'm making a mistake, please tell me, because I don't want you to just watch me roll down a hill. And that's something that I've absolutely adopted and embraced, is that we should be open to challenge.
Yes.
You can't say, oh, well, I'm the senior guy, I know it, and you don't need to tell me. Well, you're not going to learn anything then.
Exactly true. Exactly true. Sid, thank you for your time. That was brilliant.
Thank you very much.
And thank you everyone for listening. We'll see you next time. Hopefully that was useful to help you understand a little bit about what's going on in markets at the moment, and also what it takes to be right at the frontier of fund management, running a highly successful fund.